Well, if you thought yesterday was quiet, and really the last few days have been quiet, and when I say quiet, I mean below average range, below average volume. That's my definition of quiet, no matter what the plus or minus is. Very small moves in the markets. Today took the cake. Today was like a half day of trading and one full day in terms of the volume and the trading range. You have to go back to like last Black Friday to see us this small. Very, very light until the end. And at the end of the day, we finally got some fireworks. We finally hit the 5,000 mark, so triple zeros in the index value. And we literally hit that at the high and came down. It came down. Now, just a few points. We didn't close there. So we're still lacking the close above 5,000. But at least we hit it. So that's, party favors around and tip your cap to the S&P for making it within what? I think 21 was when we hit 4,000. So it's been like almost 3 years. So interesting move today, though. It wasn't necessarily the mega caps. Like yields rallied. Mega caps didn't lead the way. It was more the small cap index. So I'm going to break that down to see, okay, is that really bullish or what does that tell us? And we'll talk about what's driving this price action today. And then we'll take a look at our trade idea as a stock that's comes out with earnings tonight. Actually, it already has come out with earnings and has a pretty similar response to its earnings that it did last time. And we'll talk about how to trade that going into this next month or so. So let's go ahead and get started. Today is Thursday, February the 8th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before you go going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog today, check out some of these things over here on the right, including our Market Outlook live video, where I review all the trades in the Market Outlook videos and see whether we should stay in them or not or get out of them. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms, which is really big for us. That's why we always ask. So thank you to those who do like these day in and day out. Our goal is 100. We're getting closer, inching closer and closer to that. It's like the 5,000 mark on the S&P. But thank you again. And for those who don't do that, you can do it right now while you're watching with one or two really easy clicks. All right, let's go ahead and take a look at the S&P 500 with the market forecast indicator. You can see, again, very strong move higher, very small range, probably the smallest range that we've seen in a long time. I think you have to go back to like the half day of trading in November for us to have that small of a range. 13 points is all way below the average. And again, but up. And we did hit 5,000 at a high of the day today. We didn't close there. We closed just a few points below, but we do now have the round number in the high tag, right? We have 5,000 as an intraday high point. Of course, the near-term line, rather the intermediate line, is still above market sentiment, but doesn't take much for it to get back below it. So we do need to watch that. So it's been below it a few times. Once there, barely below it there, barely below it over here. So we'll see if it turns into something more eventually. But as of right now, so far so good. Again, your near-term lines make it into the upper reversal zone without a momentum peak that led it there. It went well into the reversal zone too. So you got up to the 95th percentile, and your momentum line barely even got to the 65th. It's already back in bearish territory. So a little bit of a concern there, but I mean that kind of goes with the small range, and that's the momentum line takes that into account, and that's the biggest reason why you're not seeing that confirmation. Your NASDAQ 100 looks very similar, also very small in the range. Very high intermediate and near-term lines, momentum line dropping, market sentiment still remaining high. Your Dow Jones Industrial Average will show a similar pattern. Once I pull it up there, its near-term line now has caught up to the intermediate line. The intermediate line is actually still slightly below the market sentiment line, so little difference on that, but the short-term sentiment looks very familiar. And then finally, your Russell 2000, which had been underperforming, really broke up today. So it got up 1.5%. It had average range, so everything else was below average, but not the Russell. The Russell had average range. Now again, that's a low average, but still, at least it hit average. And all the other indexes are low averages too, and we didn't even come close to hitting those averages. The near-term line popped up again without the momentum line, so again a little bit of a red flag there. The intermediate line is way below the market sentiment. So we need a more sustained move on the near-term line up above the upper reversal zone, above the 80th percentile, to really sustain a new rally on the intermediate basis. Because again, we are below the market sentiment, and market sentiment's falling now slightly. We did get a bear tag, which means we closed above the falling moving average. So the moving average isn't red anymore; it's yellow now because we're above it. Slightly though, we're only 1/3%. We've been above it a few times here previously too, and we're about as weak above it now as we were then. So I wouldn't put a lot of stock into this rally. That's bear tags can be the beginnings of a new intermediate run, or they can be reversal signals. And I guess the odds of it being the beginnings of a new intermediate run increase the longer you've had dark pink shading and a red line. We barely have had it for just a few days. It doesn't mean we can't turn into a new bullish trend here, but the odds are it'll be more like this bear tag, which was also in the early stages of that decline, more than this bear tag, which was the beginning of a new move to the upside. So I would expect that we'll actually probably bounce back down here from this level. That this was a pretty exuberant move that wasn't mirrored by its large cap peers, and we'll see if that turns into something weaker by the time we go into tomorrow's trading, into the end of the week, and then into the end of the options expiration next week. The 10-year yield continued higher, up 4.17%. Interestingly enough, the recent rise has not been very bullish for the Qs, or bearish for the Qs, has been bearish for the Russell. Today was the opposite, so kind of interesting there. But the intermediate line for the 10-year yield is almost in the upper reversal zone for the first time in a while. Dark green shading and a green line were above the moving average. The near-term line popped back up above the intermediate line. Well, no, it's just barely a little bit below it. The momentum line popped up above. And remember, the market sentiment line is very low, and we're above it. So we're still on this kind of bullish stage on the 10-year yield. Remember, that's one of the three-headed monsters. The other one of the three heads is the dollar. The dollar's got bullish posture still, and a little bit of a pullback right now. So remember, we've had 2 days of intermediate confirmation signals. Now your near-term line is down in the bearish territory for the first time, but not into oversold levels. So we'll see if we finally get that bounce back up, as I would expect it to be tomorrow there. And then the third head of this monster is commodity prices. And it actually got a bear tag today. So the near-term line broke above, we talked about that, broke above the intermediate line into the reversal zone for a second straight day, this time up to extreme highs. The intermediate line's turning higher, so you have the light green shading, and we're above the above there again. So again, we've had a long period of dark pink shading and a red line. So again, you would expect this bear tag to be one that starts a new run instead of reverses or continues an already current run. So those are your three heads. So I mean, two of those heads have been turning up more. The other one kind of looks like that meme where you have the three dragon heads with two of them looking really serious and deadly, and then the third one being like a cartoon character. Well, now this one had been that cartoon character, and now it's starting to turn looking mean and ugly. And you can see it being the biggest component of this index, of this ETF, is crude oil, and crude oil was up 3.5% today. Up to over 76.5. Big strong run. The near-term line crossing through the intermediate line, getting up to extreme highs. That's the highest level it's been up to. It never did get up to this peak during any of this bearish move. So we are light green shading for now. The intermediate line still moving higher, but the intermediate line is above market sentiment. It's above it on all three of those monster heads: yields, the dollar, and crude oil. So you can kind of see the bullishness in this. Bitcoin. You can see how Bitcoin is turning higher as well, almost above the 50th percentile. It's moving up to the 49th, so you have light green shading still, but you're above a rising moving average that's turned green. So things are looking pretty positive for this high-end risk asset class. And sometimes we look at the ARK ETF, Innovation ETF. This is kind of another sign of risk appetite on the high end of the scale. And you can see it had been pretty bearish during this past month or so. This calendar year, it's been pretty bearish after finishing the year on a pretty parabolic move to the upside. Well, now we're at a bear tag. And so again, is it a bear tag like this one, which I think it is, or is it a bear tag like this one, which starts a new bullish run? And again, I lean more in this camp because of the increasing bullishness in yields of the dollar and commodities, which in the past has weighed on risk appetite, especially that high end of the risk appetite scale. Let's take a look at some of these other charts here that we generally look at. The S&P 500, you can see again higher high, higher Hakinyashi close, 5,000. 6.5% there is a very, very high mark. I mean, it's not the highest, but you can see it's, again, in the 90th percentile of the last 20 years. So it's a pretty high level in and of itself. When you look at, of course, we got 3 green arrows, all the major indexes, and we finally actually have a 3 green arrow signal, or 1 green arrow, excuse me, on IWM. You don't have the MACD, and you don't have the stochastics yet. But as of right now, you have the ones. It's not, again, another reason why that bear tag might not play out, because usually when the bear tags do play out to bullish reversals, the moving average is the last one to turn green. In this case, it's the first one to turn green, and that's usually not a bullish sign. And so we'll see how that ends up. Again, nothing's 100%, but you were 3 green arrows across the board everywhere else, and haven't been, in the last 3 months, we haven't had 2 days of 3 red arrows combined among the 3 large cap indexes on the NASDAQ only, and that was it. So 2 green, 2 days of pink shading. Everything else either green or not green. Obviously not the case for the Russell, but a very strong 3-month period for the large cap indexes. Looking at the 2-line versions, of course, very strong moves there. IWM you saw breaking above the 30, the 17, the 8, 17, and the 30. But you're really converging. In fact, if you notice, aside from the 200-day, all the other moving averages closed through the range of today's range on the Russell. The 50 closed, closed through it. The 8 and 17 did. The 30 did. So all 4 averages here that we look at, the main ones that we look at, all went through the day's range. Only the 200 didn't. So give us another day or two of that kind of move, great. But just one day like that, when you're converging that much, after having already been bullish, you're more likely looking at more downside here to come. We'll see how that ends up, if that ends up being the case here tomorrow, and like I said, into options expiration week. Let's take a look now at the DMI. Still very bullish on the S&P, still not anything at all on the Russell. You got a crossover, but it's down at really, really low levels. Let's look at the RSI and the CCI. Again, still very strongly bullish on the S&P, and not very strongly bullish on the Russell. In fact, it's above 50. It's not quite above 0 on the CCI, so we're not bearish, but we're also not really that bullish either. Very neutral, actually, on those. And you see that here on this chart, too. IWM has no trend at all going on. The closest thing we have is we're close to getting above 1 and above 50. That combination means we have a weak bullish trend. Getting back above the cloud, getting above both the blue and the green lines, green line crossing the blue. Not almost a rate of change. You're still negative on the rate of change, but if we go flat tomorrow, it'll be pretty positive because we had such a big drop 26 days ago. So it's kind of a make or break tomorrow. Like, if we can break through all these, great. If we can't hold this and we're still in the cloud and we're moving towards 188, which is kind of what I'm expecting, then again, you see how this is kind of more of a fake out move today instead of an actual bullish move. Finally, on the Bollinger Bandwidth, we're still in the upper quartile of the band. It's still well above the Keltner channels on the S&P, so still very strong pattern, but not the case here. We are in the upper half, but we're not in the upper quartile. And we do have positive momentum, though we're not pushing those bands outside the Keltner channels anytime soon. So we'll see how strong that positive momentum actually ends up getting. I expect it'll be pretty weak, like we've seen in some other instances. Let's take a look at today's intraday range. You'll see here that we did get a new high with that number 5, that big number we've been waiting for a long time here, that big 5,000 number. There we go, finally come up here. So we do have a new high tag. But not like, so we have 100 there, and we're still working our way down. But you see how small that range was, and you see how we still haven't filled in that gap from yesterday, which is a common gap and more likely to fill that in than not. And there's a big gap in volume down to the point of control too. So we made a big move, and we just had, look how sideways we've been since early morning yesterday. Not the best follow through, right, to that bullish move and that opening gap and then that early morning bullish move. We are in the upper half of the IWM's chart again, but again, no new high, no new low either. They're both really coming down after a bearish one touch, which is another reason why I expect that eventually this green line will work its way down towards 0 instead of breaking out to 100 to the upside. I could be wrong, right? But that's my kind of like this, right? That would be my expectation, something like this pattern developing again, and for that matter, this one too, developing again, getting down to 0, and the red line getting to 100 before the green line actually does. I showed you today's range, and volume was very, very light. You see the volume at 52 million, the range again at 1.45 points. That puts your ATR down to just barely over 4 points to 0.81. 0.8 is extremely low here. So it's, we're bordering on extremes. The volume is low, well below where the average is. So really, really light moves. Again, heading into remember, a seasonally bullish time of year for volatility, right? Volatility tends to make one of its biggest, not the biggest move of the year. That's the July to October move, but it's usually coming off of the low of the year then, and then retest the high of the year. But this is at least where we set the high of the year during this next month, and we'll see if that ends up being the case. Volatility is extremely low here. It is, we closed below 13. We're not at the 80% mark here, but that's pretty low. The VVIX is ramping up, so the correlation is dropping. We talked about this quite a bit in our options inventory trading class today for our premium subscribers. There's a variety of factors, but needless to say, the market is ripe for a volatility jump. A short-term pop out of nowhere. Very, very ripe. Whether we'll get one tomorrow, whether we'll get one next week, who knows? But because we never know. But we do know that the environment is there for like a tornado to that. I always compare it to tornadoes. Right? You never know when a tornado is going to form, a funnel cloud is going to form, or especially when one's going to actually touch down. But you do know the environment, right? The conditions that sets us up for one. And we can get those conditions and still not get an actual funnel cloud or a tornado touching ground. But the conditions are there, and that's where we are now. The conditions are ripe, like very, very ripe. Like we are in tornado, like warning mode right now. Not even just watch, but warning mode. For a variety of factors, including some of the things I just showed you. And like I said, I did a lot more in-depth today and for our premium subscribers there. All right, now let's take a look at what's driving this price action. Again, you can see the 3-month returns. Now, IWM, all IWM, U.S. equities just in general are all up quite a bit, thanks again to weaker dollar, weak commodities, and higher bonds, weaker yields as a result. If you look at just today alone, so let's forward here to February the 8th, and you can see IWM was the big winner. Bond yields were up. The bonds were up there. The dollar was up. Commodities were up. And it put some pressure on the Qs, but not on IWM, which is interesting because since the jobs report came out and all those things started to rally, again, bond yields were up. The dollar was up. Commodities were outperforming at least. It really helped Qs go up quite a bit, and IWM lagged. And again, all three of those things happened again today. Yields were up, commodities were up, and the dollar was, was outperforming. And it was the Qs that lagged, but didn't really go down, but still stayed up 2.5% here. Again, despite the fact, and now IWM is actually up since the jobs report came out. At least since the close on Thursday, the jobs report came out, and you can see we think gap down on IWM, even though the equities, large caps, rallied that day. But still, you can kind of get an idea that that things are changing, and you saw that in the different patterns in the different asset classes that we showed you. The market forecast, the dollar's above its moving averages. The 10-year yield is Like I said, back above 4.16%, up at 4.17, above the 200-day moving average. The MACD and stochastics are rising. Commodity prices making their way back above the 17 and 30-day moving averages today. MACD and stochastics starting to turn slightly higher. A lot of that, again, of course, is because of crude oil and the big breakout it had today above its moving averages back towards the 200-day, coming off of that low point there. So you can see things are starting to slowly turn their way around. If we take a look at the major markets, the major international markets that are out there, you can see like Europe is flat pretty much across the board. Even the UK, France, over here, Italy and Germany, all flat, underperforming what the markets, what the S&P 500 is doing. And you can see the rally we had in China was short-lived. We haven't gave back all of those gains, but given back most of them. Even in Brazil as well is coming back down, and China or India also giving back some of those gains it had over the past couple of days. So not strongly bullish in most of these areas right now. The only areas that we are dark green shading the green line happens to be the U.S. markets, and then Japan and India. Korea doing okay. It really took off when China was having its rally there. Korea really took off and has been able to maintain a lot of its gains. Its intermediate line just barely getting above 60 and into bullish territory there. If you take a look at the sector grid and how the sectors are doing, you can see again it's an XLK world, and industrial is actually doing pretty well. Healthcare is rallying up along with communication services. You still have dark pink shading and red lines in these interest rate sensitive areas, as well as in materials. Energy has the light as the dark green shading because we're above 50 and rising, but we have the yellow line there, and the same thing right now in discretionary. So most of the ETFs are kind of matching with the S&P, with this few exceptions, especially like I said in the interest rate sensitive area as well as the dollar sensitive area. Remember, the interest rates are rising and dollars rising, and that puts pressure in this quadrant down here in the bottom right corner as they're sensitive to those spots. Commodity prices rising generally helps energy go up, especially again with crude oil rallying. So that's probably why energy is the most bullish of all of these. In fact, these two are, you're below 20, almost below 20 in real estate. You are below 20 in utilities. So you're setting yourself up for cluster opportunities there again. And then materials, again, it's falling. It's not in the lower reversal zone yet, but it's, they're at 30 in the bearish territory. Whereas some of these others, these are pretty strong levels, above 90 on industrials, of course, above 80 on communication services and technology, also on staples. Healthcare, you're above 90, even if it's falling right now. Both of these industrials and healthcare both falling at very, very high levels. And then financials is almost above 80 with its rising, so an 84. So you're almost at 60 there into bullish territory and discretionary. So you're pretty bullish across the board in some of these areas. And of course, like I said, not so bullish in others. And you see that playing out if I were to look at the one chart, the comparison chart, and just look again. Let's go back to when the jobs report came out here. And there's communication services, technology, and discretionary all leading the way higher. And those are the only three sectors that are outperforming the markets, and everything else kind of not just lagging the markets, but in some cases negative. Utilities down 4%. A lot of these utility stocks in the email I send out are forming, there's quite a few oversold clusters on individual names in the real estate and utility sector. Staples is also lagging over that time frame, as well as materials there. So for our trade idea, I wanted to take a look at a stock that actually released its earnings in the after hours. We put this trade on before the market closed in our Market Outlook live video. It was a firm holdings. It's down in the after hours, down to $43 here at 49. It looks very similar to what we saw, and that was kind of the idea of the trade. It got this bear tag on the market forecast chart with the potential of it really was up like 10% today. Very similar to what we saw last earnings, where it took off with a bear tag, a large amount But then you notice it had its earnings announcement. It rallied up. This one, it actually rallied up, but was pretty much bearish after its earnings. Kind of like what we see right now. We were bearish right after the earnings here. We're going to end up gapping down instead of up to the upside. But even after the initial bearishness, you gapped up there, but you were bearish right from the outset. After that bearishness, you can see what ended up happening. And that's kind of what I'm expecting here. $43, you'll notice, is actually right close to, a little bit close to the close yesterday. So it kind of filled in that gap there. And I expect that after some weakness, that will probably end up coming back up off of this low point after the open tomorrow. And we'll see what ends up happening if we continue to move higher. There was a lot of volatility on this trade. When you look at a lot of the setups here was pretty bullish here with a bullish candle on the weekly chart. The 3 green arrows, we definitely have 3 green arrows on the chart itself. You can see down in here that's if it does break down below, say, like 38, now not only do we not want to be in that trade anymore, but we're going to be looking at a bearish directional trade on this, considering its margin of safety. So something to keep an eye on after the open tomorrow morning to see if it does continue to drop, how far it does continue to drop there. The DMI, you can see, is bullish breakout pattern going into the evening. The RSI and the CCI also with a bullish pattern going into the evening above 60, well above 200 over there. And then, of course, the Ichimoku cloud. We haven't looked at that one yet. Let's take a look at firm. You can see above the cloud. So even with some weakness, I mean, you've got some opportunity. Like I said, we're at 43. 43 is right here. You're still actually kind of in the cloud, or at the very top of the cloud there, despite that weakness. That initial weakness. We'll see if it ends up holding or following through. You can see the breakout above the upper band and the upper Keltner channel, with 43 basically being back to the midpoint of the range. That's so again where right now where we would be opening tomorrow morning, if depending upon how it trades in the pre-market tomorrow morning. So a lot of good opportunity. There was a lot of volatility built into this trade. If you notice here, we did a long call vertical spread that was pretty far out of the money, with the idea of managing our risk, keeping our risk really small, and it had a 2-to-1 reward to risk ratio. When we got into this, we had a lot of, like, the max gain was like right over here. We had a lot of flexibility built into this trade. Coming down to 43, which is where we're at right now, that's where the brown line is, we still have some room to run up. So you can kind of see the volatility of the market. Let me get rid of this. The volatility of the market, the volatility that was built into this because of the earnings announcement, gave us a really good reward to risk ratio, and allowed us to have a really good flexibility in terms of timing our entry into this trade. So despite a $6 drop from the open, there's still a pretty decent opportunity for us to get up to that maximum gain. So I like that opportunity, and we'll see how the market opens up. And like I said, if we break down even further and break down below the lower Bollinger Band as well as these other lows, because of that really poor margin of safety here, we'll be looking at more of a bearish directional trade that I'll most likely cover potentially in tomorrow's Market Outlook Live video. So that's our trade for today. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like me on Twitter and Facebook as well. Have a great rest of your Thursday night, everybody, and we'll see you all next time.